Hello there, this is James and you're watching Tixee Live. In fact, you're watching a Tixee Live watch-along of the EU CPI announcement or the Consumer Price Index announcement. But before we get into all of that, don't forget these little videos are for educational purposes only and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your diligence, and of course, know the risks at hand before entering any trade. With that out the way, let's get started. Okay, so today we're doing a watch along of the EU CPI announcement. Plus, because we weren't able to do a little bit of the morning session today, we'll do a little bit of an update of what's happening in the market as well. But for those who are new to trading, you may ask, what is the CPI and why is it so important? Well, the CPI is the Consumer Price Index, okay? And this measures the change in the price of goods and services for the consumer, for you and I, for what we're paying for goods, be it food, be it clothing, be it anything, okay? And clearly, obviously, this is important because the more expensive things become, the less likely we're able to afford to buy them. And that impact has a big impact on the economy for several reasons. For one, the economy relies on us to spend our money. And if we can't afford to buy things, we can't afford to spend our money. The other reason why this CPI is so important is because it indicates to the market what the central bank might do, for example. So if inflation is high, which it is, then the only way, one of the main ways that the central bank can tackle inflation and bring inflation down, okay, is to increase interest rates. So this is why the market looks at this very, 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 very closely, especially at the moment, as we are going through a huge inflation crisis, record highs inflation, well, not quite record high, but 40-year high inflation across the board. Now, usually when the number comes in, if it's higher than expected, then it can be potentially positive for the currency. The reason being, if it comes in higher, the market goes, right, that means the central bank is going to be aggressive and will increase interest rates further. If it comes in lower than expected, then it can be seen potentially as negative for the currency in question, because the market then looks at it and goes, right, no, it's still low. The central bank is not going to be aggressive and raise interest rates. So it can be negative for the currency. Now, the expectation for the year-on-year reading is to come in at 9.1%, which is a record high for the EU. Now, the previous reading was at 9.1%, so the expectation is no change. However, it'll be interesting to see, because it's not just the one number, we have several. We have month-on-month as well, and we have core CPI, okay? The difference between the normal month-on-month and year-on-year and core CPI is that year-on-year and month-on-month, which is the headline inflation rates, takes into account very volatile commodities, such as energy, okay? Because the theory is the central banks can't control the energy market, okay? So that includes that. But core does not include fuel or energy. It just includes clothing, mobile phones, pens, things of this, other things the consumer needs to buy. And that's the difference. Now, month on month on the headline rate is supposed to be 0.5%. That's the expectation. Core, like I say, is supposed to be 0.5%. And core CPI year on year is 4.3%, both extremely high. Now, here's the thing. Don't forget the inflation targets for most central banks, including the ECB, is 2%. So these potential, or these expectations is way above their current targets, way above. So, and as well as that, we have seen a steady rise in, say, headline inflation. I know back in, March, it was 7.4. Then in April, 8.1. May, 8.6. June, 8.9. July, 8.9. August, 9.1. And we're expecting 9.1. So again, a steady rise. So like I say, the way to tackle this is for the ECB to increase interest rates. And yes, they started to do so. They have started to raise interest rates. But the question is it too late? Yes, they didn't surprise the market, but they did raise rates last week by 75 basis points, which for them is pretty aggressive. It's pretty aggressive. And like if you said to me several months ago that the ECB is going to raise interest rates last week to 75 basis points, I would have said you're pulling my leg. But yeah, that was aggressive. But they have to. But they've acted so slow. So is their action a little bit too late to tackle this? Now, there is more talk that they're going to do another 75 in the next interest rate decision, and maybe even more aggressive. In fact, ECB Vice President Luis de Gaudos, I believe it's pronounced. I'm sorry if it's wrong. I'm rubbish at names. He says the slowdown of the economy is not going to take care of inflation on its own. He goes on to add, the slowdown of the economy will reduce demand pressures, which will lower inflation. But, he went on to say, simultaneously, we have to act from the monetary policy standpoint to keep inflation expectations anchored and avoid second round effects. What does he mean by that? Basically, what he's saying by that is that, yes, there is signs of economic slowdown in the EU. Okay, obviously, they have a huge energy crisis, which they're really struggling with at the moment, which in many people's minds, mine included, is just going to get worse in the future. But what he's saying is the ECB has to carry on raising interest rates, has to be more aggressive. So yeah, there is really expectation that they will do another 75 basis point rate hike, but maybe even more. But the question I have to ask at the moment, is there any way of stopping the dollar? Because dollar strength across the board, it's just so dominant at the moment. Because, like I say, the Fed has been a step ahead of the ECB all along. They've been raising interest rates for a lot longer, a lot quicker, and a lot more aggressively. So they're already ahead of them. So, but is there any way? And plus, their economy is pretty robust. We got some reasonable data yesterday. US retail sales came in mixed, but not bad, not great, but not awful. At the same time, their US initial claims came in better yesterday. So that was pretty good. But like I say, there is any way of stopping it. Could this event start turning it around a bit? The pairs in particular I'm going to watch is going to be the euro dollar, obviously, and the euro sterling. Because the sterling, if we're talking about the euro having a bad time of it, okay, bad time of it, the sterling is having even worse. It crashed today to a 37-year low as UK retail sales came in, announced it negative month. This is month on month, of course, negative 1.6 versus 0.5%. Negative 0.5% expected. So there is real recession concerns in the UK. So the sterling, euro sterling in particular, I'm going to watch. I'm not sure if this event will really move the euro dollar, but the euro sterling will be interesting to watch. Anyway, scenarios. Scenario one, it comes in as expected. The market's priced it in. Very little difference to direction. Scenario two, higher than expected. The euro potentially gets an initial boost as the market expects more aggressive rate hikes for the ECB. I don't expect that to last. And then scenario three, lower than expected, the euro continues to weaken. And scenario number four, no matter the result, there is no stopping the US dollar. So anyway, we're about to have it. It's about to come out any minute now. This is the euro dollar. Let's have a look. Have a look. What it is. What does it come in? Very little action on the euro dollar at the moment. Let's have a look at the euro sterling in the moment, because that's the pair I'm more interested in, to be honest. Let's have a look. What was it? When it come in, bear with me. Okay. Right. Year on year, as expected, but month on month comes in slightly higher at 0.6 versus 0.5%, slightly higher. Core year on year comes in as expected. So as expected, pretty much. Breaking news, as expected, comes in at 9.1%. Very little difference in the market as it's already priced in, as we mentioned. So very little action, already priced in, already expected it. But more importantly, let's look at the euro sterling. Okay, again, slight weakness on that. Priced in already, no big surprises. The only real surprise is the CPI month on month, which comes in slightly higher at 0.6%. Not over dramatic, no real change on that. So yeah, it remains as it is. So yeah, but this pair in particular will be interesting to watch as the day develops. Okay, so there we go. Not the most exciting event, not as dramatic, clearly, as the US CPI, which did surprise the market dramatically, because obviously that came in higher than anticipated. This has come in pretty much as expected, and the market is pretty much priced it in and ignored it in general. So yeah, while we're at it, let's have a look at the sterling, actually, because I wanted to quickly talk about the sterling. I know we're doing the CPI, but as it's priced in, there's very little action on this. But let's have a look at the sterling at the moment. Like I say, it's trading at a 37-year low. Not since Margaret Thatcher was Prime Minister has the sterling been trading at these levels. Trading at 1.13781. Real concern now for the UK. Going to drip into recession, as you say. Those who joined me on my hashtag Ask James episode a couple of weeks back, you see we still got our trend line, which is holding there quite steadily. Yeah, so, you know. The other thing about this, of course, the big event for the sterling will be next week, of course, which will be the Bank of England interest rate decision. It was supposed to happen this week. This week was supposed to happen, but unfortunately, obviously, due to certain events happening in the UK, it's being postponed now till next week. So it will be happening next week. So that will be a key effect. Whether or not the Bank of England, who are a tad little bit more direct than the ECB, but not by much, will do a 50 basic point rate hike this time, or maybe 75, which I think they need to do, because don't forget, UK's inflation is still very, very high. Was it 9.9%? I think it is at the moment, just under 10, but it's extremely high. But anyway, yeah, this is going to be an interesting pair to watch. Right. Don't forget, you can ask me questions anytime you wish, or simply say hello, or share with me your opinions. I mean, what do you think about the euro, for example? Where do you see the euro going? I mean, there was talk of the euro. Like I said, obviously, we bring up the euro again. Very little difference on the back of that CPI. Nobody paid attention to it. I think they expected it. So very little. Still very much on a downtrend, of course, obviously. So yeah, let me know what you think. What do you think about the euro? Can you see the euro bouncing back? I mean, if it needs to bounce back, the ECB needs to be really more aggressive to fight it. But I don't think there's any way of stopping the US dollar at the moment. We have pure dollar strength across the board. You know, for several reasons. Expectations, obviously, of the Fed being more aggressive with interest rates. They have been far more aggressive than the likes of the ECB, Bank of England. The other reason, obviously, is recession concerns. Don't forget, the US dollar is a safe haven as well, so that's getting its attraction. And like I say, we're getting not great, but reasonable data out of the US, as opposed to data like from the UK or from the EU. Like I said, the retail sales yesterday came in, not for US, that is, 0.5% positive, whereas the UK negative 1.6%. So again, one economy seems to be holding stronger than the other at the moment. Same with the EU as well. But yeah, okie doke. If there is no questions, not a problem. Don't forget, I'll be back online again later today, around about 2 p.m. UTC, to cover the US session and further developments throughout the day. The only other big event we've got coming up today is the US Michigan's consumer sentiment. That obviously is a survey about seeing how confident the US consumers is. So that could potentially be a market mover. So we'll probably be, I think it comes out at 2 p.m. UTC. So we'll be on air at the time of that announcement, so we can watch the market, see if that has any impact. So don't forget, I'll be back online again later around 2 p.m. UTC. So please feel free to come and join me. Anyway, if there is no other questions, not a problem. Don't worry. If you think of a question later, don't forget, you can put it in the comment section, either on Facebook or YouTube. I will see them and I will reply to them next time I go live on air. You've always got that option too. Anywho, like I always say, if you're watching me on Facebook and you've enjoyed this little video and found it useful, by all means, give it a follow. If you're watching me on YouTube and you enjoyed this little video, by all means, subscribe if you'd like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and found it interesting and you've put up with me, my over-the-top enthusiasm for the markets, which I simply just cannot help because I love the markets so much, then give me one of these. It's nice to know that you like what I do. I see I've got a couple of likes already, which I really appreciate. And I really appreciate all of you coming along to share this watch along with me. I'm sorry it wasn't a massive, exciting mover, but you know, these events are still very, very important. Anyway, till next time. Don't forget, these all videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. So I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.